First thing I want to talk about with foreign exchange risk is foreign exchange rates and how they're quoted, because it's not particularly clear how to quote foreign exchange rates. So first off, let's talk about what a direct quote is. So a direct quote is where what I have, the currency of interest, is in the denominator. And so if the direct quote rises, the currency of interest appreciates. Now the currency of interest from the United States perspective, if we're talking about foreign currencies, is probably going to be a different currency than the US dollar. Now an indirect quote would put the currency of interest in the numerator. So the difference is where we put that. Let's do this example. Hopefully it will make sense. On October 9th, 2019, 1 euro bought 1.0981 US dollars. Now, in the US, we would probably make the euro the currency of interest. Right. Now the direct quote for the euro would be $1.0981 US dollars buys 1 euro, or simply USD 1.0981 for 1 euro. Now you may be more familiar with using this notation. Use the dollar sign and the euro sign. Why do I use these three-letter abbreviations? Because this is common with foreign currencies. This way we don't need to have a different symbol for every single currency that's in existence in the world, because we would need well over 100 of those symbols. And the nomenclature typically is the first two letters represents the country, and then the last letter represents what the currency is called. So hence US dollar, USD. Euro is the one exception, because euro really isn't a single country's currency. I'll talk more about these triplets that summarize or that represent currencies later in the lecture. But they're very convenient to use, so we don't have to hunt and look for a special symbol on our keyboard. Now the way to indirectly quote the euro would be to say that 1 euro, that's going to be in the numerator, buys $1.0981. Now usually we do not quote ratios this way. We usually like to quote things per 1 unit. So if you're going to use the direct quote, you would have to divide 1 by 1.0981 to get 0.91066387, to be super precise. If we round it, then we might not get exactly 1.0981 if we take the reciprocal. And of course we could also represent that with the more well-known symbols when we talk about euro and US dollar, but when we talk about a lot of other countries' currencies, it might not be so obvious. Now, if the exchange rate that in 2014, so 5 years prior, was $1.2628 buys 1 euro, which currency appreciated? Now remember, it's the direct quote that tells us what happens to the currency on the bottom. So since 1.0981 is less than 1.2628, which was the exchange rate 5 years prior, the euro depreciated, which means it lost value. And if the euro depreciated, then that meant that the dollar appreciated. Right, now on a more real world or intuitive, practical level, just consider what these numbers mean. If you have €1, you're only going to get $1.0981 right now. 5 years ago, if you had €1, you would have had 1.2628. So the euro would have bought more dollars 5 years ago. Therefore, the euro had to have been more valuable 5 years ago. On the flip side, we could say that the US dollar now is so valuable that it only takes $1.0981 to buy €1, whereas 5 years ago the dollar was less valuable, so it required more dollars to buy €1. Namely, it would have costed $1.2628 to buy €1. Right, now, like I had told you, there are all these three-letter abbreviations for currencies, and I just want to go over them now. It's a little fun to talk about them, but they're so common, and I don't want you to be confused if I use these, and if you see them when you're reading about exchange rates. We've already discussed the symbol for US dollar is USD. The Canadian dollar is CAD, CA for Canada, D for dollar. That's why the Canadian dollar is sometimes called the CAD. The New Zealand dollar is NZD, and the New Zealand dollar is sometimes called the Kiwi. Might be able to guess Australian, AU for Australia, D for dollar. The euro, EUR. The British pound, now that could be lots of things because we have the UK, England, Great Britain. We use GB for Great Britain, so Great Britain pound. Swiss franc is a very important currency, and that one is not so intuitive. F for franc, but Switzerland is abbreviated CH because of language. And I looked it up once on why Switzerland is abbreviated with CH, and it makes sense when you look it up. I think it has to do with its name in Latin. Maybe you're wrong about that. You can go check me on that. Japanese yen, JP for Japan, Y for yen. The Chinese yuan, which is also called the renminbi, some of you might be laughing at me and how I'm saying that, is abbreviated CNY. The Mexican peso, MX, and before you think it's a P, it's actually an N. The N stands for Nuevo Peso. Brazilian real is BRL. I can't tell you why it's an L there, not an R. Alright, now I put South African Rand and Saudi Arabian Real right next to each other because you might think, well, how do you tell them apart? It seems like it would make sense that they'd both be SAR. Well, the Saudi Arabian Real is the one that gets SAR. The South African Rand gets a Z instead of an S to differentiate it. So the South African Rand is ZAR, and then finally the Indian Rupee is INR. And you can look up three-letter codes for all the currencies. They all in existence, but I think these are the ones that you will see most often. All right. Now, one other thing I need to address is that if you go to look up a currency, you will typically see them represented like this. You might think that you would read EUR/USD as the number I will see will be euros per US dollar, but it's actually the reverse. Let me just show you. Let's look up the euro. We see EUR/USD. What does that mean when you see EUR/USD? In fact, we even have the slash sign. When you see just the pairs like this, and you do not see the number within the pair, it's basically saying the exchange rate of EUR/USD equals 1.0736 this instant. That is actually telling you the USD over the EUR. So right now, at 4:07 p.m. on March 23rd, 2020, we see it's 1.0735. The EUR USD is equal to 1.0735. This actually means Euro buys 1.0735 US dollars, which is equivalent as saying that the exchange rate is 1.0735 per 1 euro. Now, why on earth would they represent it this way? They put what looks like is the numerator is actually the denominator. What looks like the denominator is the numerator. When the number is put on the other side of the equal sign like this, as opposed to within the fraction, it's telling you the value of the euro in terms of dollars is $1.0735. So that if that number goes up, it means the euro's going up. So it's actually, in that sense, intuitive, but in another sense, definitely counterintuitive. So you might need to go back over this portion of the lecture just to keep this straight, because when you have different currencies, there's always this question of, well, which currency are you valuing? If you say the euro-dollar pair is this, well, which number do you mean is the numerator and which is the denominator? And a lot of times it's not real clear, but people who are accustomed with foreign exchange markets are so used to the numbers that they can tell by looking at it, oh, well, clearly we know that $1 doesn't buy 1.0735 euros, it's always the other way around. So sorry, it is confusing, but I feel that often students are not warned about this, and so I'm just trying to warn you. It is confusing. It's not super obvious. Don't feel bad if it's not making sense to you. Just take some time to work with these, and you'll get used to it. All right, a few final terms I want to go over is that there are two different markets for foreign exchange. There's a spot exchange rate, which is a quote for how much it would cost to buy or sell currency right now. And then there's a forward exchange rate, which is an agreement to trade currencies in the future. We'll come back to spot and forward later. Now, there are many ways in which a financial institution could be exposed to foreign exchange risk, but the thing that I really want to focus on for this course and in this chapter is the mismatch in currencies between assets and liabilities of primarily a bank, a commercial bank. So if a bank lends in a foreign currency but borrows, that is, takes deposits in the domestic currency, then its overall return, will be determined by changes in the foreign exchange rate. If the foreign currency depreciates, remember that's the one that it makes a loan in, relative to the domestic currency, then the bank will lose more money than if the foreign exchange rate does not change. Right? So if you make loans in England in pounds and the borrower pays you back principal and interest, but the value of the pound goes down, you've received something that's less valuable relative to the obligation you have in dollars. Now, one number that is asked in a lot of the problems is what's called net return. And so let me just define that for you right now. we're going to define the net return as the future value in the home currency of the assets minus the future value of the liabilities divided by the present value of the liabilities. So the liabilities is what you borrow right now, and then you lend it out. You're going to receive some proceeds from that loan, and then you'll owe the ones you've borrowed from, which are your depositors, right? And so this is all in the domestic currency. So after you've converted the currencies back. All right, so let's apply it to this problem. Interesting. So we have a U.S. bank that raises $500, and this is actually in millions, $500 million from issuing a one-year CD in the U.S. that pays 4% interest. Now it's going to take $300 million of that and lend it in the United States at 6%, and then lend out the equivalent of $200 million of those deposits in Germany at 10%. The spot exchange rate is 1.25 euros. Now, if the spot exchange rate doesn't change, let's just keep track of things right now. So we have right now, and then 1 year from now. We have the deposit, it's $500 million, and in 1 year, since the rate is 4%, the bank will owe its depositors $520. The U.S. loan will be $300. The interest rate in the U.S. is 6%, and the bank will collect $318. In the German loan, I'm sorry, it'll be so the equivalent of 200 US dollars will be lent in Germany. So let's see how many euros that will be. So 1 euro per $1.25. And that will be 160 million euros. Then after 1 year, 160 million euros will be repaid plus interest. The interest rate will be 10%. Be 176 million euros. And then when we convert it to dollars, because we're assuming that the exchange rate doesn't change, this would be worth $220 million, which we could have figured out by just multiplying 1.1 times 200, but later on we're going to see what happens if that exchange rate changes, and so it'll just be easier to look at it this way. So the net return will be 318 from the US, 220 from Germany, and then you have to pay back 520 from the US deposits, and you were working with $500 million. So for the $500 million you collected in deposits, you've made a total of 538 in cash flows from the assets, but then you have to pay back 520 in deposits, 18 over 500, and you get a net return of 3.60%. Now, what would happen if the spot exchange rate changes? Well, all of this stays the same, but the GM loan changes. I'm sorry, the Germany loan changes. So the German loan we're still lending out 160 million pounds, and we'll still receive 176 million pounds, but what that turns into dollars will be different. So using this exchange rate, we'll find out how many dollars we'll have. So 176 times 1.15, and that would convert to $202 and, well, 202 million, $0.4 million. Now the net return would be still 318 from the US loan, but now we'd only have 202.4 from the German loan. We'll still owe 500, just as much in the United States. We had originally worked with $500 million. So now we have a paltry $400,000 for a $500 million original investment. And basically nothing. It is positive, at least. Now, you could probably gather if the euro depreciated a little bit more than this, like to $1.1, $1.05, now we'd have a negative return. The only thing that changes is the German loan. So we're still making a loan of 160 million euros. We're still receiving 176 million euros, but it will convert to this many US dollars. 237.6 million US dollars. The net return will be, so just recall the numbers we'd calculated because the US portion remains unchanged. We get $318 million from the US loan. We get $237.6 million from the German loan after converting it to US dollars. We will have to pay back our depositors $520 million. Again, this was all done off of an original amount of $500 million. So we have a net return here in dollars of 35.6 over 500. Giving us net return of 7.12%. So even though it is possible to lose money because the exchange rate for the euro depreciates, it's also possible that we could get an impressive almost doubling of the return if we're lucky enough that the euro appreciates by this amount. But whenever we talk about risk, of course, we're more focused about the losses than the possible gains. So how could we manage this risk? There are two ways that we'll discuss. One way is to issue the equivalent amount of liabilities in Germany than what we're lending in Germany. This is called an on-balance sheet hedge. So remember we saw that if the dollar went down like this, if the euro went down like this, it was bad. Well, now we have a US deposit, so we won't rely so much on deposits in the US. We'll only raise 300. The interest rate in the US for deposits were 4%. So looking back at the problem. So the bank would owe its depositors $312 in the US. Now the spot exchange rate today was $1.25 per euro. Right, so let's look up what interest rate we would have to borrow in Germany at. So the German CD rate is 7%. So we would owe 171.2 million euros. And then if the dollar appreciates and the euro depreciates to $1.15 per euro, then that would be equivalent to $196.88 million. The US loan is the same as before. We're lending 318. We're lending 300 at 6% interest, 318. That work was done previously, so I'm not redoing it. And then we'd already worked out that the loan in Germany will be 160 euros. And we had worked out that when if the euro's value is $1.15, that will be worth $220 million. So you can just go back to that part 1. So we had worked out that if the euro were worth $1.15, then that would be worth $202.4 million. So just look back at part 2 of the previous problem. I'm just going to write that here. Giving us a net return $318 million from the US loan and $202.4 million from the German loan. And having an obligation of $312 million to US depositors and $196.88 million to German depositors. And that was all earned off of an original $500 million in assets and liabilities. So we divide the numerator by denominator. We get 2.304%. And so the big takeaway from this problem is that by issuing deposits in Germany that's equal to the amount lent in Germany when and if the euro depreciates, we have a decent return of 2.304%, whereas if we raised all of our deposits in the US, we would have had a paltry 0.08%. Right, now let's see what would happen if the euro appreciates to $1.35 per euro. And the only thing that, let's just write the things that changes. We have the German deposit. So we had already calculated that the German deposit would be 160 million euros, and in euros, going back up, we found that we'd have to give the depositors 171.2 million euros. So we have 171.2 million euros, and we're going to convert it now at $1.35 per euro, the possible future spot rate, and that would be worth $231.12. Then we have the German loan, also was 160 million euros. The interest rate was higher in the German loan, so we will be collecting $176 million. That was just calculated in the previous steps, or previous subsections, and then we convert that to dollars, and that would be worth $237.6, which we had actually calculated earlier. Now let's calculate what the new net return would be. So the US return is the same as what we had calculated earlier, 318, plus the loan in Germany, which will be worth 237.6. The German deposit will be 231.12, and then we have deposit being 312, again over 500, and we get a net return of 2.496%. So we also have about the same return as when the euro depreciated, but we give up the possible gain from the euro going up, because when we raised all of our funds in the US and the value of the euro went up, we would have had a net return of 7.12%. So we trade off the possible gain from the euro going up in order to have a stable return of about 2.3%, 2.5%, and whatever returns we get will be somewhere in that range because we've matched the currency of the asset to the currency of the liability. Now, another way that we could control the risk of foreign exchange rates changing is what's called a forward hedge. So with a forward hedge, you use a forward agreement, a one-year forward agreement, to sell euros at $1.20 per euro. And so when you have this contract, you have this promise that you can sell the euros for this price in 1 year. So what would happen is that we're going to go back to the original case where we borrow all in the US. The German loan in 1 year, we had already calculated, would be 176 euros, and we would lock in $1.20 per euro to get $211.2 million, and then we'd have a net return of 318 from the US loan, 211.2 from the German loan, minus 520 owed to the US depositors over the original amount of 500, giving us a return of 1.84%. And that would be the return regardless of what the spot rate happens to be. So it actually didn't matter that the spot rate in 1 year is 1.15. We don't have to use the spot rate to convert our euros into dollars, because we have a forward contract that promises us that we can sell euros for $1.20 per 1 euro, and therefore the net return, if the spot exchange rate in 1 year is 135, is exactly still the same, because again, whatever the spot rate is in the future is irrelevant. And so by using the forward hedge, we've locked in a gain of a net return of 1.84%, regardless of what future exchange rates are. And so in exchange for locking in this net return, we give up the possibility of having a higher return if the euro appreciates. Also, if the euro stays the same, note that we also sacrifice what the return would have been of 3.6%. But there's no guarantee it will stay the same, no guarantee it will go down, no guarantee it will go up. And so if you don't want to have the risk of a much lower net return or negative net return, you could use the forward hedge, and it will be 1.84%